Today we're discussing an investment strategy that may outperform in 2022 based on the current market environment with raising rates, pressure on growth stocks. The strategy is known as the dogs of the Dow. The overall strategy is focusing on high yield value stocks that are in the Dow Jones Industrial Average, and we'll be going over the details of how it's set up as well as the performance, in my opinion, on the strategy for the long term. The strategy was actually created back in 1991, and the reason it's called the dogs of the Dow is because when you call a stock a dog, it usually means that it was a bad performer of that year. So what the dogs of the Dow does is it looks at the 30 companies that are in the Dow Jones Industrial Average and picks the 10 companies with the highest dividend payout on a percentage basis. And the allocation of capital is split evenly amongst these 10 highest yielding companies, and the positions are established as well as liquidated on January 1st of every year. The concept is quite simple. You take stocks that did poorly the year before, and in a reputable index like the Dow Jones Industrial Average, we're talking about these mega corporations that probably aren't going to just go away overnight. So they're still profitable, and since they had a bad year in the past, they may outperform as those sectors that they were in pick up and outperform in the next year. With the year coming to an end in 2022 starting, you have a new list of dogs of the Dow. These are the top 10. Before we dive into the results of this strategy, let's take a quick break for the sponsor of this video, Tornado.com. Want to get paid to learn about investing? You can with Tornado.com's Learn and Earn feature, getting paid up to $50 taking different lessons, which will show up as rewards deposited into your account. Come back the next day and repeat. Sign up at Tornado.com or through the app and check it out. Shout out again to Tornado.com. Also, if you do end up joining, you can follow me there, and I essentially curate news for different stocks that I follow, and you'll see me give a little blurb about the news and how I think it might impact the stock. If we look to performance, we'll see that the dogs of the Dow in 2021 actually underperformed. It had a total return of 16.3%, and if you compare that versus the S&P 500, that came out to around 28.7%. As for long-term performance, unfortunately, I can't find a data set that shows the performance from 1992 till now that compares the dogs of the Dow versus something like the S&P 500. If you look up on Wikipedia, you'll find that they do have a data set from 1992 to 2011 that shows that it pretty much matched the Dow Jones returns, and it actually outperformed the S&P 500. Of course, we know from 2012 to 2021, we've had a pretty big bull market for growth. If we look at some more recent years, like 2020, it underperformed the Dow Jones and the S&P 500. In 2019, it underperformed with a 13.5% return versus something like 26% for the S&P 500. I think it's clear that a high value, high dividend portfolio is going to underperform when growth is doing super well. So while I couldn't find the perfect data set for something like the S&P 500 versus the dogs of the Dow, I did find this research that outlines the performance of the dogs of the Dow 10, the small dogs, as well as the Dow 5. So these are slight variations to the strategy versus something like the Dow Jones Industrial Average itself from a time period of 1996 all the way to 2016. This strategy outperforms around 16 out of the 21 times over that period. Overall, these slight adjustments versus the 30 companies that are in the Dow Jones actually does outperform over a longer term basis. If you're trying to get exposure to the strategy, unfortunately, there isn't an ETF out there that matches the strategy exactly. There are ETFs like DJD, which has a pretty good correlation because 56% of its assets are in these dogs of the Dow companies. The percentage split amongst these companies isn't exactly even, but if you're looking for an ETF that will have a correlation to the strategy, DJD is one option. I'm also a big fan of Vanguard ETFs because of the low expense ratios and the variety of ETFs that they offer. VYM is also a high yield ETF. This is something that may not have the exact exposure to the dogs of the Dow, but it has a lot of companies that have higher yields that also may perform well in this type of market environment. My prediction for 2022 and looking at these companies is I actually think the dogs of the Dow is a valid strategy for 2022 and that it may outperform based on you have energy, you have retail, healthcare, you have consumer defensive in here, big tech, these companies that are more value related, especially Intel when you compare it versus AMD as well as Nvidia. The multiples for a lot of these companies are much lower. They have high capital cash flow still. Sure, the growth isn't there, but when you're looking at an environment where cash flows right now are valued more importantly than future cash flows, that's why the strategy looks pretty interesting. And it really comes down to where you think we are in the business cycle. Fidelity, their latest research puts us approaching the later part of the business cycle, meaning that companies like energy, consumer staples, materials, utilities, these companies or sectors that are actually in the dogs of the Dow may start to outperform this year, and growth sectors like information technology and consumer discretionary may underperform. One thing I'll say about this strategy though is I don't think it outperforms over the long run. So if you keep on repeating this, I think it underperforms something like the S&P 500 or the NASDAQ, stuff that has more growth in it. So these higher yielding companies tend to be more of a safe haven for down years. Over a longer period of time, growth is going to outperform. On a short-term basis, if you go into a recession, then the dogs of the Dow will outperform. It's just whether or not your time horizon is long enough where you don't care about the volatility in something like the S&P 500, in something like NASDAQ, and that's where you'll get higher total returns. If you guys did enjoy this video, make sure to hit that like button, as well as consider subscribing to Main Street Wolf, where we're talking investing, stocks, anything to do with money. Thanks guys for watching, and have a great day.